All right, I think we will get started here. So welcome everyone, and thank you so much for joining us here on this Tuesday morning or early morning, depending on where you are in the world. So today's webinar, we're discussing everything Regulation A for the issuers. So we've got two great panelists here for you, Sarah Hanks and Darren Marble. I will let them both introduce themselves here. So Sarah, do you want to go first?
Okay, hi everybody. This is Sarah Hanks. I'm founder and CEO of CrowdCheck and managing partner of CrowdCheck Law, and we provide a wide range of legal compliance, due diligence, and compliance solutions for both the issuers and the platforms making Reg A offerings and all of the other sorts of offerings you can do under the Jobs Act.
Wonderful. Thank you so much for coming here today, Sarah. I think this will be a great webinar, and we're excited to have you. Darren, do you want to go ahead and introduce yourself?
Sure. Thanks, Emily. Thanks for having me back on, and pleasure to be on a webinar with you, Sarah. I'm Darren Marble. I'm the CEO and founder of Issuance. We're developing a private placement and capital formation platform for both digital and traditional securities issuers. Issuance recently acquired my legacy financial marketing firm, CrowdFundX. CrowdFundX has marketed about half of the Reg A plus IPOs in the US and has been involved in the marketing of maybe 20 Reg A plus campaigns since the exemption went into effect in the US in mid-2015.
Awesome. Well, thank you for coming back, Darren. This is great. And the last webinar you did with us was very well received, so we were very excited that you were able to join us again. So without further ado, I think we'll jump right into it because I know we have a full agenda here. But Sarah, maybe why don't you start us off? Just give us a quick, what is Regulation A+? Who would use it, what it sort of involves, and so maybe some of the benefits or limitations of it.
Okay, so Regulation A is, and I should always point out, I never say Regulation A+ myself because it's a nickname and I'm a lawyer who's stickler about names. But Regulation A+ is the popular name for a series of amendments to existing law that was made back in 2015. This regulation, Reg A, was an exemption from full registration with the SEC that permits a company to make a public offering without restrictions on the securities that are being sold, but not to go through the full SEC process. So it's an exemption for a public offering. It's a public exempt offering. And that's important because it's public. The securities that are sold are not restricted. They can be free trading. If you can find a place for them to trade, you can trade immediately after the qualification of the offering. The companies who can use Reg A are US or Canadian companies. The company does have to actually have some management in the United States. And the SEC does look at that. If you end up having a dispersed workforce and you've got part of your management team in Nepal, say, which has happened to us, you can have the SEC ask, are you really a US company? Are you really being managed from the US? So US or Canadian companies with management in the US. It now, the people who can use it include all types of companies. It used to be you couldn't use it if you were a registered company, fully registered company with the SEC. Since this January, companies who are public companies can use Regulation A, and I'll explain in a moment why you would do that. The other thing that I want to flag on who qualifies is you can't use it for an investment company. Now, an investment company isn't just like a mutual fund that you'd normally think of. It's any company that holds interests in other companies. So it comes up a lot in real estate, where if you've got a fund, a holding company who owns 10% in the company that owns this building and 5% in the company that holds this building, those are minority interests. They're going to be treated as the so-called investment securities by the SEC, and a company more than 40% of whose assets are investment securities gets treated as if it were an investment company, can't use Regulation A. So that's something that comes up, as I say, frequently with respect to real estate companies. Why would a company choose Reg A? Well, you're able to go to sell to everybody, not just accredited investors. You can also go, let's say if you're a consumer electronics company or a clothing company, you can go out to your customers and get them that one. I'm sure Darren has some comments to make about using that to get offering to your existing fans. So you can sell to anybody. The securities are not restricted. It is easier than doing a full registration with the SEC. The standard of liability is lower, as we'll see in a minute. It's not non-existent, but it's lower than it would be for a full public offering. It's easier to get through the SEC, and most of all, you can make full use of all of social media and all of the internet, whereas traditional securities offerings have always been very restricted as what they can say and how they can say it and what they have to deliver when they're saying it. Although there are some tricks you need to know, in general, you can use the whole of the internet to get your message out to companies, to investors. So those are all really good benefits. Limitations are you can only sell up to $50 million. So it really is, for startup companies. There are some legislative proposals to increase the amount. Those may or may not go through. You know what Washington's like at the moment. And then with respect to certain investors, if you're not an accredited investor, then you can't invest more than 10% of your income or net worth. But you'll be insane to do that anyway. And so people tend not to run up against those limitations. But there's Reg A in a 2-minute nutshell.
Perfect. Wonderful. So Darren, before a company chooses Regulation A+, is there, from a marketing perspective, is there anything they should be considering that may affect their decision to go Reg A+ or not? And then maybe you can get into, once a company has decided to move forward with Reg A+, what are some of the best marketing tactics or best practices for them in a marketing perspective?
Oh, absolutely. So, the most interesting question to me is what companies are ideal candidates to use the Reg A securities exemption as a capital raising tool. And just because you might be eligible to do a Reg A offer doesn't mean you should. So, if there's a cliff that's 50 feet above the ocean and you're on that cliff and you can see the ocean, doesn't mean you should dive in. You probably need to be a professional diver or prepare, and maybe that's a decent analogy. But the point is, I say that you don't choose Reg A. I say Reg A chooses you. And what I mean by that is I think the Reg A exemption discriminates in that it will favor a very particular type of issuer, and it will punish and harm another type of issuer. Historically, looking back over the last 3.5 years, Reg A tends to favor consumer products companies, B2C companies, companies that have established businesses, are generating millions or tens of millions of dollars in revenue, have a paying customer base. That may be the number one criteria to determine whether or not you are a good candidate to use this exemption. So inherently and intuitively, issuers that have a built-in audience of paying customers are more likely to succeed on average than an issuer that is a startup, pre-revenue, pre-product. In fact, I would say 99% of the time, startups, pre-revenue, pre-product companies are terrible fits for Reg A+. And really what it comes down to is distribution. So the enhancement here is that you can now generally solicit or market your deal, which is an incredible opportunity, but it creates a challenge. And so the question is, how do you solve that challenge? If you are a company that has an audience of paying customers, you're going to have an advantage. If you are determined to use this exemption and you don't have an audience, then what is your distribution strategy? Do you have an investment bank that is willing to underwrite your deal and you're competent and can raise capital through either institutional investors, which has been uncommon, or retail brokers, which has been more common. So that's kind of the first question an issuer has to ask. And then based on the type of company you have, the marketing strategy is going to range. Some deals can raise capital without any retail involvement, which, by the way, if you're thinking of doing that, I would wonder, why are you doing a Reg A campaign? If you're not going to attempt to bring in retail investors into the offer, why bother with all the cost and time and effort in the first place? So generally, companies that use Reg A are doing it because they are inherently a strong fit, or they're determined to offer investment in their business to everyday Americans or anyone over 18 globally around the world, because philosophically that aligns with their vision or their mission or their values as a business.
So, Darren, do you think if a company chooses to go the Reg A route, from a marketing perspective, they need to set aside a larger marketing budget for that because it is a broader audience base?
Yeah, so Sarah won't like hearing this, but I think for every dollar you spend on legal, you should spend $2 on marketing. And I'm biased, of course, but I do think that at a minimum, issuers need to be realistic. You should not try to raise $10 million on a $10,000 marketing budget. That is unrealistic. That is a fantasy. And let me just take this back for a second. We got our start marketing rewards-based crowdfunding campaigns, companies that were raising $1 million, let's say on Kickstarter or Indiegogo. On average, almost every company that ever raised $1 million for some product on a pre-sale almost always spent about $100,000 or 10% to get there. So truthfully, it can be quite costly and expensive to raise capital from the crowd. And that's something that every issuer needs to be aware of. They have to have their eyes open, wide open, going into these campaigns. It is not easy to raise millions of dollars from everyday Americans. And by the way, that's true even if you have your own customer base. It's still a costly and challenging undertaking. But I would advocate for, on average, at least $100,000 marketing budget, if not $250,000. And that's if you are a serious issuer going down this path. I would ballpark the cost to do a Reg A all in at maybe $500,000. I'm sure it's been done for less. It's definitely been done for more. But between your marketing, legal, and auditing costs, and then there's compliance costs and other smaller fees mixed in there as well, it's probably a $500,000 project. And again, I think on average, issuers should allocate as much as they possibly can for marketing, since that to me is where the opportunity lies. Right.
Interesting. So we'll jump forward here into a bit of the process here. Sarah, what does the due diligence look like with a Reg A+?
Okay, well, in many ways, it doesn't look that different. I'll talk about the ideal world and then the real world. In the ideal world, it doesn't look that different from if you were doing an IPO. In the event, and we'll get into the actual liabilities that you're protecting from in a second, but in an IPO, you've got investment bankers and lawyers and people who represent the investment bankers and people who represent the company, all looking at the company's documentation, legal due diligence. They're looking at the markets for the company. You know, how good is this? How much of a fit is this for the bankers' client base? And then you're doing physical due diligence. You know, going and looking at the plant. When you're dealing with Reg A, you have to do a sort of scaled down version of that, because it is not going to be cost effective. I mean, for all that Daryl's saying, I mean, we're working with a lot of companies who don't have a $500,000 budget. Now, whether they should or not, I hear Darren about that, but the important thing is that the company has got to protect itself, and it can't just go out there making statements about, itself, its history, its product, and its prospects without having somebody check all of the things that they're saying. So, like I say, in an IPO, you've got a cast of thousands. In a Reg A offering, you're going to have a much more limited team, and that might be just the company's own lawyers. If the company is using a broker, and I'd be interested in hearing about what Darren thinks about should you ever go out without a broker, and how the brokers add to success. But if there's a broker in the loop, they have to do diligence too. So the who is everybody who's got liability. And the people who have liability are the company and its officers, the broker if there is one, the platform if they are using a platform, and then anybody else in the loop who is involved in promoting the offering. If you're involved in a misleading statement, you're going to have some form of liability. So the what is going to consist of looking at the company's history. Is it properly incorporated? You would be amazed in crowdfunding how we've come across companies that are out there selling securities and they no longer exist. Luckily, it's not happening so much in the Reg A space, but we've seen it in Reg D, we've seen it in regulation crowdfunding offerings, where the company has failed to pay its franchise taxes in Delaware and it doesn't exist anymore. And yet it thinks it's selling securities. So starting at the absolute basics, is the company in existence? Is it in good standing? Has it approved whatever it is that it's selling to the market? Looking at all of the various approvals, if it has an employee stock option plan, did it approve that? Looking at the cap table, is everybody on the cap table? Can you trace them to a legitimate issuance of securities? And those are things that we always do. So that's corporate history. Then you have the business itself. Does it have customers? As Darren says, the companies who are doing best in this space are the guys who actually are making stuff or services and selling them. So you need to look at who are they selling them to. Is there actually a customer base there? Speak to the customers, look at the contracts, make sure that whatever the company is saying about who it's selling, what it's selling to, is actually true. And then, as I say, in a big IPO, you would physically go to the company and sit in its offices and look at what it's doing and how it's doing that. That's something that's always a challenge when you've got, for example, some of the companies we work with have dispersed workforces. Are you going to go to everybody's desk to say, okay, now show me what you do and give me proof that you're actually producing a product here? So that has to be all adapted for the modern internet offering stage. But it's in many ways, it's just the same old due diligence that people have had to do since the beginning of time because the liabilities have not changed.
So operationally, from a team perspective, if my company, say, was looking to do a Reg A, should I be allocating someone on my team to just be responsible for due diligence, whether that's working with the brokers or working with the lawyers, or is that something that is typically outsourced out on its own to these lawyers or whoever is involved?
You do need somebody on the company's team. I mean, that's one of the things that we always ask for is give us one person and we will harass that person. And that person will be the center for all of the questions, and they'll know who can answer the various, who owns the documents, who owns the information. But there really does have to be serious company compliance. And I know it's a pain. I mean, we're forever going, oh, that's an interesting statement that you're making in your offering circular there, that, the market for your product is X trillion, bazillion dollars. What's your basis for that? And we keep saying, give us support. What's the basis? But it's to protect them. It is to keep them safe. And so if you have one person who is the recipient of all the annoying legal questions, that really does help the company.
And I can jump in and add to that. I think one of the critical success factors in a Reg A offer is CEO involvement. If you are the CEO of your business and you're not on a weekly call with Sarah or a marketing firm, the audit partners, I think you have a high risk of failing. And if I look back at the campaigns we've been involved in that raised capital successfully using this exemption, in every deal, the CEO was front and center. He or she was present and accountable. This is not an outsourced engagement in any way, shape, or form. You're not paying a lawyer and a marketing firm and an audit firm to do this IPO or Reg A offer for you. So just, word to the wise, you as the CEO need to be present and really leading the charge. And that's been a common denominator in the successful deals. One other comment, because Sarah asked, would we recommend a broker in a deal? I think the question is, it depends. And from my standpoint, largely depends on, do you plan to attempt to list to a national securities exchange or an alternative trading system or ATS like OTC Markets Group? And then secondly, how much capital do you want to raise? And if you're looking to IPO and you're looking to raise more capital than less, I think you absolutely need a broker. And again, if I look back to the campaigns that we've been involved in that raised the most capital, and I'll use Fat Brands, for instance, it's the parent company of Fat Burger, which is a huge restaurant chain here in LA. That was what we call a hybrid Reg A plus IPO. So there was an underwriter that diligenced and priced the deal, took the deal out, distributed it to their network of retail brokers on Wall Street, as well as institutions. And then we were charged with doing the retail marketing, all the digital marketing, driving prospective investors online into a lead funnel. And in total, about $25 million was raised. $8 million came in online, $10 million came in from a group of more than a dozen retail brokers, and about $6 million came in from two smaller institutional investors. So what was interesting about that deal is our firm acted as a lead generator. I think we had maybe 4,000 leads that were generated in that campaign. And based on the data that we were collecting on prospective investors, we were able to pass off the top 5 or 10% of those 4,000 leads to the broker dealer and say, look, we think this segment of our lead list is the high value lead list. These are the Glengarry, Glen Ross leads. Somebody should pick up a phone and call these people, because we think that not only are they likely to invest, but these are 25K plus indications, meaning these are the high dollar retail investors. So when you have a broker dealer, not only do you have a quarterback in a capital markets leadership team that can help facilitate a listing to, let's say, NASDAQ or NYSE, but you also have a firm that has registered reps who can legally go call and sell and sell shares of stock or upsell existing investors. And so that was an important strategy that we've employed quite successfully over the years.
Sorry, just 1 second here. My screen decided I needed an update. Okay, so let's, sorry about that. So let's just, let's stay on that sort of operational sort of due diligence topic here. And Sarah, you touched on this a bit, but the liability factor here, from each side of it, from the issuer and for those who are promoting it, how does Reg A plus affect sort of the liability?
I mean, I'm going to start, talking about section numbers and rule numbers here. So sorry about the legal details, but there's a number of regulations and rules that can be the basis of liability in Regulation A. The first one is Rule 10b-5, which is the one that says you cannot make a misleading statement. And there's been a couple of Supreme Court cases over the last, I think that there was one, 2010, I guess now, which addressed the issue, what does it mean to, quote, make a misleading statement? And in some cases, that's going to reflect not just on the issuer who is clearly making the misleading statement, but also on the platforms on which they list, or anybody else who is promoting the offering. the Lorenzo case that we've got referred to here, which came out last month, that took it a step further and said, it's not just, you don't just have liability for making a misleading statement. You have liability if you disseminate a statement. In that case, a broker took some information that his boss had put together, put it in an email, stuck his signature on it, sent it out to some investors, even though he actually knew that it was false. In that case, he disseminated a misleading statement. For liability under Rule 10b-5, you need scienter, which is the concept of bad acting, bad intent. But that also, you can have scienter by just being reckless. So if you look at the information your boss has put together and it wants you to send out an email and you go, geez, I don't think that's right. But, it's nearly 5 o'clock. I want to leave the office. I'm sending it out anyway. There's your recklessness. So you've now made a misleading statement recklessly, and you have liability for it, whether you're the platform or whether you're the broker or whether you're the issuer. The next level up in terms of difficulty to prove is Section 12A2 of the Securities Act. That imposes liability for misleading statements unless the person making the statement is able to show that by the exercise of due diligence, they did not know that the statement was misleading. And so that's that's why you really want to be doing due diligence, because you have that liability. If you are the issuer, if you are a broker, for sure. Probably if you're a platform, nobody has ruled on this yet, but the only way you escape that is by showing that you did due diligence and you couldn't have known that it was false. There's another section I want to flag, which is Section 17 of the Securities Act, that gives you liability for misleading statements. And unlike the other two sections I just mentioned, in this case, there is liability not just for making the statement, but also aiding and abetting. Now, this section is different than the others because it's only the SEC that can sue you, but the SEC does sue you, which they did in Lorenzo. And then the final sleeper section is one that was introduced in Dodd-Frank. It's Section 9A4. Which imposes liability for a willful participant, somebody who willfully participates in the making of a misleading statement. So there's 4 bases of potential liability, all of which can be protected against by doing due diligence to make sure that you have done the diligence and that the statements you're making are not misleading. And then on top of that, state laws. There's a whole bunch of states out there. They've all got slightly different rules. And so whether and who is liable and under what circumstances will differ from state to state, but some of them can be really quite fierce. And so the bottom line is, not only just, don't say something that you know to be untrue. Obviously, people are not going to do that, but don't do it by mistake either. Don't be part of a scheme where everybody's like, do you know whether that's true? Well, I don't know. Did anyone check? I don't think this is checkable. If somebody is making a statement, make sure that somebody has checked whether it's accurate, and that will protect you a lot.
Interesting. Darren, do you have anything to add there? Just so, I guess, because you'd be one of the people speaking on behalf of the company if you're, promoting an offering. I guess due diligence is very important to you, but do you have any experience of, mitigating liability or not mitigating liability, but mitigating risk in that sense?
Yeah, look, we're a marketing firm and we're extremely sensitive to compliance in how we market offerings on behalf of client issuers. I think, look, the bottom line for the issuer is you need a highly competent and seasoned securities attorney, truthfully someone like Sarah who knows this exemption in and out. Your objective is not just to raise capital. Your objective is to mitigate risk, risk of failure, risk of violating securities laws in one form or another. And these are things that have very real consequences that most people would never want to deal with. So, what we've done over the years is we have a workflow and a methodology where when we're putting out content, let's say it's art and copy for a Facebook ad, art and copy for an email marketing campaign, we're engaging a YouTuber or Instagram influencer to promote an offering on behalf of a client. We run almost every piece, if not all content, by a securities attorney like Sarah, in addition to having issuers counsel review and approve all the assets that are developed and ultimately utilized in the campaign. By the way, the assets that you develop for your marketing campaign, they need to be archived, and ultimately they're submitted, as part of the 1A filing. I believe it's an amendment. Maybe Sarah can clarify. And another thing that we've learned from working with Sarah is that the content that you put out as an issuer, the way you market the campaign, has to match the content in the offering circular. So you can't have one set of information in your Form 1A offering circular, and then you go out and you're promoting your offer with a different metric or piece of information about your business, that there's a mismatch, a different number, statistic, etc. So having continuity between the information that you have filed with the SEC and the assets that you develop to market your investment to prospective investors, they need to match up. So I think bottom line is you got to lawyer up, and I would highly recommend working with someone who knows this exemption. Anytime we're in a deal with a lawyer that we haven't heard of or has not done a Reg A filing, we cringe a little bit. Not to say that attorney can't figure it out. It just means that there's some risk that the issuer is taking on and they need to be conscious of, and they'll probably pay a higher fee to help that lawyer learn the ins and outs of this exemption. So I'd recommend working with an experienced attorney that knows this exemption, and that's probably your best strategy to mitigate risk.
So Darren, on that note, we had a question come in. The question is, what are the rules for marketing language in your landing page for your Reg A offering? So I guess, we talked about, making sure it's factual and true information, and we talked about making sure it matches your circular. But outside of that, is there any rules set about what you can or can't talk about in your landing pages online?
Well, everything I've learned, sorry. I was going to say I've learned a lot from Sarah over the years, and so I steal her language. But what you shouldn't do is you don't lie, cheat, or steal. So let's start there. If you don't lie, cheat, or steal, you're ahead of the curve. Look, Reg A gives you the ability to market and promote. I would generally recommend that issuers be cautious in being overly promotional. If you are too aggressive, and you see this in the ICO space, we've seen it so much when somebody promotes a guaranteed return, run. That's a red flag. The more you're hypey, you're too promotional, you're too aggressive, people aren't idiots. That scares them. They have fear because they think they're about to lose money. I think the more you can be fact-based, and it's okay to have forward-looking statements and include projections about the growth trends in your industry or your forecast for the year or the next 3 years. But I think you just want to have a very balanced perspective. Investors, again, they're not idiots. If it's all rosy and you're going to be the next Facebook and this is a guaranteed winner, people aren't going to buy into that. And it's one of the reasons why you have to include a lot of disclosure and risks in your offering circular, because anybody who invests could lose some or all of their money. And I think if you go into your marketing campaign with that mentality, how do you communicate risk? What are the things that could go wrong, and what are your strategies to mitigate those things? That to me is being authentic. It's taking ownership of the realities of business, that things work and sometimes they don't. So maybe that was a broad overview, but Sarah, I know you've got a thought or two, so would love to hear your take.
Yeah, so I'm going to start with the end of your comments first. And on the projections side, there's no prohibition on projections in the securities world. If you do use projections, the the SEC, and they will be looking, the SEC is going to want to see robust assumptions. You can't just go out there with, we are assuming hockey stick growth over the next 10 years. You want to show why you think that might be the case. You would also want any projections to tie in to any legends that you have with respect to forward-looking information and precatory language there. And also be very clear that, as Darren says, there are risks. So tied to the risk factor. Here's our projections, but they are subject to all of the risks. And if any of those risks happen, projections aren't going to happen. To go back to the beginning of the question, you should, on your landing page, there should always, always, always be a link to what was filed with the SEC. If you are post-qualification, that link has to be a one-click link directly to the text of the offering circular as it was filed with the SEC. Doesn't have to be on the SEC's website. You can link to EDGAR, you could link to something that you've made much more beautiful, but there has to be a link to whatever was filed with the SEC. And then again, everything that's on that webpage is an offer of securities. And as Darren says, all of that collateral material, all of those assets have got to be filed with the SEC under its Exhibit 13, I think, so that the SEC will look. And one thing I can say from experience is they're going to look not just at what you filed with them, but they're going to go onto the internet. They do have access to the internet. They can see what investors see. And they will click through the company's entire website. And if the appropriate legends aren't there, if the appropriate links aren't there, they're going to have an issue. If there's a statement that is inconsistent with what's in the offering circular, as Darren says, they're going to have an issue. And if there is a statement that is just, insane, they're going to say, can you give us some background for why you are making this statement? So, bear in mind, the SEC reads all of it. And as Darren says, some lawyers just aren't used to the ability to use the entire internet to make offerings. And in a traditional IPO, you're very constrained about what you can say, where you can say it, how you can say it. No constraints in Reg A, but you're subject to liability and you're subject to the SEC going, oh, that's interesting. Tell us why you're saying that.
Well, one other thing to mention, because we're talking, compliance, and obviously it's of the utmost importance in the context of any Reg A offer. Clearly, there's a marketing element to it too, and setting up a landing page sounds easy. It's more complicated than it sounds. I would recommend, keep the landing page clean and focused on the investment opportunity. If you're a consumer products company, you can have your website for consumer products and leave it as is, but your investment page should be focused on the investment. If you're selling products, you're selling shares, and you're looking for distributors or suppliers, you've got links to all of it, people are just going to bounce. They're going to be confused. We've spent years, looking at trends and finding patterns and ways that retail investors engage with Reg A campaigns and how they convert. We work closely with Fund America and Prime Trust. They're an escrow technology company, also transfer agent business. And they have both a plug-and-play solution. It's an API where investors click a button that says Invest Now, and then it pops up the workflow. They also have a custom portal. Anyways, I think you want to have a very fluid landing page and ability to check out in a seamless process. So having a clear message, a clear call to action is critical. If you want to see a sample campaign we've done, hightimesinvestor.com is one that's processed over 25,000 retail investors. As far as we know, it's the largest Reg A campaign by sheer volume of investors. So, that's a landing page we spent a lot of time customizing, but having a clear, simple page, call to action, I think is really important.
Awesome. So Sarah, while we have the liability slide up, we did have a question come in from the investor perspective. Under Reg A, is there any liability on the investor side?
No. I would assume, I mean, as an investor, you're going to represent that you're not investing more than 10% of your assets. In the history of all of the things that have been imposed on investors, I don't think anybody's ever been sued for misrepresenting their accredited status, never mind something like this. So no, there's no liability, and it's not like, I know I've spent a lot of time in international markets. There are some circumstances in other jurisdictions where shareholders are liable for things that their company does. That's not really the way we're set up here. So yeah, you're not liable for anything bad the company does, but you might lose your money if the company turns out to be a bad idea.
Okay, wonderful. And the question just came in. You mentioned real estate. I believe it was Darren mentioned real estate. In terms of companies best suited for Reg A, are there any blockchain or DLT companies that have successfully gone through a Reg A offering?
Maybe almost. I mean, if we were talking about a year ago, I'd be saying, well, there are at least 12 that we know of, companies that we know of that have filed for Reg A. And what's happened to pretty much all of them so far is that they've had very frustrating conversations with the SEC about how whatever their blockchain thing is. In the case of a company that is merely using blockchain technology, that really shouldn't be an issue. In the case of a company that is recording its securities on blockchain or distributed ledger technology or something equivalent, then that should not be an issue, but it has turned out to be more of one, because you have these conversations with the SEC going, okay, so where's the wallet? We're going, in several of the companies, like, no wallet. This is not like the things that you've heard. There's not the scary stories. We're just using this technology to do this function, which is the recording of ownership of these securities. That's still a continuing conversation with the SEC. One thing I would note is that a number of the companies who are intending to sell tokens, it's just a manifestation of shares. It's just a recordation of the ownership of the security in a slightly different way. A number of the companies that had planned to use tokens and had filed to for their Reg A offering to cover tokens, they've just said, okay, fine. The thing the token was going to represent was a preferred share. We're just going to sell preferred shares. That's it. And then what they're going to do later, as I know some of your clients have done on CoreConnex, they are now using CoreConnex and therefore using distributed ledger technology to do the thing that the SEC had all of the issues with. And so the SEC has very sadly written itself out of that conversation, because it would have been lovely to have the SEC's input on how we explain how all of this works. And it's different for everybody. Not everybody is using Ethereum. Not everybody is using the same technology. It would have been good to have some guideposts about how we were going to explain that. But that's the way it happened. The SEC had so many questions, so many rounds of comments, that so many companies gave up. There's at least 2 I know who are still persevering. One of them was in stealth, has come out of stealth recently. I'm assuming that their lawyers, who are great lawyers, have done so because they think they've got the questions cleared. So I hope we'll see that soon. So long story, over the last 18 months, many have tried, none have actually made it yet. We may be on the verge of somebody making it through.
Wonderful. I look forward to that day. So we had a question about that process. How long is the typical approval process for a Reg A filing, and sort of outside of blockchain specific companies, just in general? And what does that comment process usually look like? Is that usually a lot of back and forth, or what can someone expect going into that?
Yeah, we usually say that a company should allow for 3 months to get through the SEC, which is about half what you'd expect if you were doing an IPO. In theory, you could be through in less than 2. I explain that to a lot of our clients, and they would say, well, we're going to be the first one to do it in 57 days, and it never happens. Small companies have always got something else to be doing. But allow 3 months and you'll probably be fine. The SEC has to get back to you after the first filing. They have to get back to you within 30 days. It's usually 26, 27, 28 days. The comments are fewer than you would get in a traditional IPO. They tend very much to be focused on, if you don't make it with this offering, where you're going to get your money from, how long are you going to survive, what are you going to do if you don't raise all of the money that you're looking for, what's your burn rate, what's your runway. They care very much about existence for the next 6 to 12 months and what you're going to do if you succeed, what you're going to do if you fail to raise the money. Much less of a focus on financial statements than I used to see when I was doing big IPOs. It's very rare that we get much of a comment on the financial statements. It's very focused on early stage companies. After you've received your first round of comments, you get back to them. They now have 10 business days, 2 weeks to respond to you. There's probably going to be another round of comments. And then, will there be a third? It really depends whether you had any arguments with them. So the comment period and the number of comments obviously gets smaller as you get towards the end of the process. I've got a lot, apart from the fact that I truly regret that we couldn't have the conversation about blockchain, distributed ledger, and all of that stuff to the extent I wanted. Otherwise, I've got a lot of praise for the SEC. I mean, that they have scaled this process to something that is appropriate for earlier stage companies.
Wonderful. So we had a few jurisdictional questions come in. So the first one, can a company qualify for a Reg A Plus using a Delaware LLC, but located in Puerto Rico?
Well, Puerto Rico is in the United States, so yeah. Yeah, that would be fine.
Perfect. And then you mentioned a Reg A offering is available for everyone. Does this apply to potential investors outside of the USA?
That's a really good question, and comes up a lot when I'm representing platforms. From the US point of view, yes, absolutely. Can be, so long as you don't spend more than 10% of your income on net worth on the investment, you can invest, whichever jurisdiction you're in. But that's just the US answer. From the point of view of the place that you are selling securities into, you have to make sure that you've complied with local laws, whether they are laws about what kind of offerings can be made, who they can be made to, what you can say, and who can make them, so that the equivalent of offering registration in that jurisdiction and the equivalent of broker-dealer registration. And one thing I would flag is that in the early days of Reg A, we ran into problems with Canada, Ontario, where Ontario takes the view that if you take money from somebody in Ontario, you have made an offering into Ontario. And so the offer and the people making it must be in compliance with Ontario registration or exemption rules. Not every jurisdiction takes that view. Some of them, which tend to, well, they tend to be, the less strict jurisdictions, are generally of the view if you're not actively marketing into their turf, they're not going to bother with you unless something goes wrong.
Wonderful. That was actually the third question specifically to Canada and Ontario. So perfect to answer that one. So Darren, I'll jump over to you now. We had the question, how do you typically generate leads for your investment? Earlier you talked about sort of the different the retail investors, the brokers, and the actual clientele of the company. But do you have a typical formula you use, or how do you sort of go forward with looking for leads?
So we look at the marketing for Reg A campaigns, and we segment, marketing strategies into 3 buckets: paid media, earned media, and owned media. Paid media is if you had a $100,000 budget and you spent it between Facebook ads, Google AdWords, Yahoo, paid influencers, etc. You're buying media to drive awareness, and that traffic, is going to, let's say, a landing page or portal or website where you can build a lead list. Earned media is PR. So is your offering newsworthy in some way? Can you secure an interview on Jim Cramer's Mad Money in the test the waters phase? Can you get a story in the Wall Street Journal or in a digital outlet? And then owned media is you've got a customer list. You've got 50,000 customers and another 25,000 newsletter subscribers and 3 social media accounts, people who see your posts. That's your owned audience. Generally, any Reg A campaign we've done, one of those buckets drives the campaign. So in some instances, it's helping the issuer sell the investment to their own audience. If you don't have an audience, you generally need to have a campaign that's newsworthy, a brand that's newsworthy, or you need to have a substantial paid media budget so that you or we or another partner can drive awareness and allocate that paid media budget accordingly so that you can collect leads. So those are kind of the 3 different strategies. Each issuer, each campaign is slightly different. Fat Brands or Fat Burger was largely driven by PR. Myomo, which was a Reg A plus to the New York Stock Exchange, was largely driven by paid media, affiliate marketing. Elio Motors was their own audience. They had 50,000 reservation holders, people that had signed up to get a car in the event the company ever produces cars. So it's a really great question, and the answer is the strategy will depend on your business and where you or we think the greatest marketing opportunity lies.
Awesome. And Sarah, a bit of a, operational question here. Is the equivalent of an offer memorandum under Reg A, is that the offering circular? And is the offering circular necessary to qualify for Reg A plus?
Yes, I mean it's part of the offering statement, the what is filed with the SEC. It's the offering document, which could be in the Reg A context, it's called the offering circular. It's the same as a prospectus, basically, and in many ways, for anybody out there who remembers what prospectuses looked like back in the 70s and 80s, where they were just really, really thin, as opposed to today's monster disclosure documents. That's what it looks like. It is a prospectus, and it is absolutely necessary. The SEC does pay a lot of. The SEC has always assumed that it would be the offering document. I think when they were writing the rules, focus a lot on what goes into it. And yet, as the market has evolved, it has become a very largely online market, to the extent that I think the SEC may not have expected. And so there were statements from SEC staff early in the day, just like when we talked about, well, we'd put some information on the landing page that wasn't in the offering circular, and the SEC was like, well, why would you do that? And it's because it looks sexy. It's a different presentation, but providing that it is consistent with what's in the offering circular, providing that it is truthful and accurate, it is possible to have the pitch made primarily by the landing page, but you've still always got to have the offering circular, and you've always got to have a link to the offering circular so that people can see all of the risk factors and all of the other official stuff that the SEC wants.
Okay, and this next question is for both of you. Do you have an example of a successful Reg A raise that was primarily non-institutional investors and non-accredited investors?
Sure. I would say Elio Motors and High Times, which is a cannabis magazine and more recently an events company. Both of those deals were driven almost exclusively by self-directed retail investors. 90% plus of the investors were US based. And well, the common denominator, of course, is these are brands that have been established to some degree and have some semblance of an owned audience. Elio Motors has a reservation list. High Times has millions of followers across their Facebook, Instagram accounts, a big email list, etc. And you can imagine, the emails of a lot of people that like cannabis that go to cannabis cups. So those were 2 deals that work with retail. there were some accredited investors in each of those deals. No institutions, no retail brokers distributing the deal. And by the way, I think as an issuer, you want to get retail in your deal, right? Retail investors, someone comes in for $500, you've got someone who is now emotionally and financially invested in your outcome, in your brand, in your vision. That's really powerful. You have 1,000 people like that. You've got a little mini army of brand ambassadors that, believe in you and are rooting for you. And then if you actually succeed in having an IPO, the retail investors, that's your sticky money. They're actually like institutions. Generally, retail are long-term holders of stock. They're not trying to make 25 cents on an IPO when you go from $5 to $5.25. So there's a lot of strategic value to having retail investors in your deal. They can promote, they can be ambassadors, they can share, and they also tend to be long-term holders. So those are two examples of companies we've worked with that were driven almost exclusively by thousands of retail investors, 25,000 in High Times and almost 6,500 in Elio Motors.
Awesome. We have a client with CoreConnex that we like to talk about, Brewdog out of the UK, that has, I think they're like 97,000 investors, and they're highly engaged. Like you said, like they're not putting massive quantities of money in each. They're putting in a little bit each, but they get say in what the next brew will be, craft brewery, things like that. And they're highly engaged, and they're customers as well. So you have 97,000 investors, but you also know that you have 97,000 customers. So I think that's a lot of value in that perspective. And this, I think, oh, sorry, go ahead.
Yeah, I would add to that. There is a downside. It's kind of a cute downside, but to the extent you're looking for a very large number of investors, and another one that you should throw into that mix is Legion M, and another brand that had success was Highlight. People loved the product. They bought the shares as well as the clothes. Once you do that, once you have 97 or however many thousand of investors, you're going to have some kind of investor management structure, because you do not want them calling every day saying you should make this, citrus beer, or you should do different yoga pants, or you should, you've got to have gone into this with a plan for how you're going to wrangle your crowd. And I know that's something that, CoreConnex can help with as well. And Darren, I don't know if you've got any spin on that as well.
No, I agree. I think that's where investor communications and investor management is crucial, and that's why we're big fans of CoreConnex and their platform. I think Brewdog actually takes the crown. 100,000 investors, that has to be a record, Emily, so congrats. But I think that's really important. So half the battle is acquiring your investors, and then how do you communicate, how do you provide regular updates? And of course, there's companies here hosting this webinar that do just that. So huge value add for those types of issuers.
And I think we just have time for one last question here. And I guess you'll both have a different perspective on this, but the question came in, what are the legal restrictions for working with a marketing firm like, say, Issuance?
There's no legal restrictions. Our contract is straightforward. One thing we're not, is important to point out, we're not a broker-dealer. We don't charge success fees. So if you're going to work with a marketing firm that is not a registered broker-dealer, know that that marketing firm legally cannot charge you success fees, incentive-based or success fees. They can't take a % of the raise. Those are kind of basic things, but there's really no restriction. I think the key is you need to have someone on your team that is competent in digital marketing. If you are running a Reg A and there's a digital marketing piece to it, or look at a firm like ours and vet the contract. Have your lawyer look at our agreement or look at the other marketing firm's agreement and make sure it checks out, and always ask for references. I think that's key to running a business, whether it's Reg A or something else. You want to work with partners or Connect, Sarah Hanks, that have experience in what you're doing. And I think that's, again, a really important way for you as a business owner to mitigate risk.
And
right.
I would agree with that. And I would say outfits like Darren's who seek advice and listen to it, get advice from the right people and then follow that advice, that's the best way you stay safe.
Perfect. So I think we're pretty much at time. Maybe just quick 30 seconds each. Do you have any final thoughts on Reg A just before we close out here?
I would just say I'm noticing that some of the states are starting to take an interest. And so never discount the states, especially when it comes to allegations of fraud, because we've come across a couple of those recently.
I think do your homework. This is a big undertaking. It's a mini IPO, and therefore it is complex. Even though it's faster, cheaper, easier than an S1 IPO, you need the right partners. Doing your diligence on partners out of the gate is really critical. They can oftentimes determine your success or failure, and make sure that you've got the time to allocate as CEO and you've got a team underneath you who can be dedicated to the project as well, because it's a substantial undertaking. And buckle up, it's a ride.
All right, Darren, Sarah, thank you guys both so much for coming on here. I think that there was a lot of value taken away. For anyone who asked questions, because I know they're still coming in now, and we didn't get to all of them, we will get to your questions, just like we did at our last webinar. We'll post a blog with all the questions we didn't answer, and we'll provide the answers for them, and we'll send out the link to that blog with the recording of this webinar, so you can have a look at that. Sarah, again, Darren, thank you guys so much for jumping on here. This was great. Thank you so much.
Thank you. Thank you for hosting it.
And thank you everyone who attended, and we will see you next time. Thanks.